Good morning, good afternoon, and good evening. It's my pleasure to be here today with celebrated post-Keynesian author Marc Lavoie to discuss his new book, Post-Keynesian Monetary Theory, a book containing selected papers on money, credit, and central banking spanning close to 4 decades. The book, published by Elgar, is now out, and it contains 20 articles of Marc's papers on the topic. I would add that this book comes out in addition to 2 other books published earlier this year, honoring Marc and his colleague Marius Sekereccia, with a 2-volume Festschrift also published by Edward Elgar, and both books contain a total of 34 articles. We did a launch of these books back on August 22nd, and I will be putting a link back down in the description so you can see it if you haven't so before. Marc and I go along a while back to 1985 when I was a young student at the University of Ottawa, when I took his first class, Introduction to Post-Keynesian Economics, which would become his 1992 book, much celebrated book on post-Keynesian economics. The class was an eye-opener for me, and obviously I've never looked back since. I know this story resonates with many young scholars today who have shared similar stories with me, often having read some of Marc's papers. So these stories are the reason behind this collected essays, this book of collected essays, and I'm happy to introduce to you today Marc Lavoie. Good morning, Marc.
Good morning, Louis-Philippe, and good morning to anybody who eventually will be listening.
So I have a series of questions, and I'll be asking them, and many of these are based on the book itself, and I then go over or beyond the book a little bit. So one of your very first published articles was written in French and published in 1982, and I think a version of it in 1984 in the Journal of Economic Issues, which is the first chapter of the book, first paper of the book. And in that article, you sort of go over the bridges between the theory of the monetary circuit and the ideas contained in post-Keynesian economics. Recently, I read a paper that you sent me that discusses the bridges between the post-Keynesians and the institutionalists on the topic of money as well. And throughout your career, this has been a common theme of yours, the idea of linking together various approaches, various heterodox approaches, not only on the theme of endogenous money, but indeed in macroeconomic in general. Why do you think, or why do you insist on seeing the unifying elements of orthodox schools? And why is it so important to you while others, and I'm thinking here of the debates, not only of the horizontals back then, but on MMT today, why are there some who prefer emphasizing the differences?
Well, I think first, I think it's within my nature. I think the second reason is that I studied in France, and at the same time that I was studying in France with these people doing the monetary circuit, I was also reading a lot of post-Keynesian works written by Anglo-Saxon writers. And so I guess I got into the habit of comparing and seeing what the similarities were rather than the differences. But maybe I should add that I'm not always seeing similarities. There's a limit to how much you can integrate. For instance, there are many Marxists who still believe that gold is the thing behind the money. So this kind of belief I cannot integrate within what I think is post-Keynesian economics. And about circuit theory, I could say, well, I never really accepted the views that were being put forth by the Dijon circuit school, in contrast to, say, the views that the so-called Paris circuit school, Alain Parguez, and those of Graziani, which I think integrate very well within post-Keynesian economics at large.
Yes, thank you. One of these influences, I guess, is you took classes with T.K. Rhymes. So while you were studying in France, you had been exposed, obviously, to the ideas of the post-Keynesians before.
Well, T.K. Rhymes got really into money maybe a bit later. He was mainly concerned with the Cambridge capital controversies. Um, yeah, it's funny because when we were taking his course, it was a full year course. We always wondered, why is he teaching us this stuff when it seems so difficult? And then we found out he had published a book about it.
Yeah, well, speaking of, you ended up writing a book on a lot of the Cambridge theories as well.
Yes, that book, which is in French, was half about growth theories and the other half was about the Cambridge capital controversies. And especially there's a chapter on its impact for the measure of technical progress, which was the forte of T.K. Rhymes.
Just as an aside, 2022, in fact, will mark the 50th anniversary of Jeff Harcourt's book on the capital controversies. Anyways, just to mention that. So question 2, in section 2 on inspiring authors, you have papers on Caldor, on Jacques Le Bourgeois, and Eichner. In fact, Le Bourgeois appears prominently in your 1982 article, which I had to reread for this. And I know from having taken your class that Eichner figured prominently way back then as well. And I know of Caldor, your fondness for Caldor as well. Are there any other influences in your career on money and banking in particular?
Well, I would say obviously Alain Parguez was an influence. The first year I was in Paris as a graduate student, he was replacing the guy who was the full professor there. So half of our classes were being given by Alain Parguez, and at the time he was writing, starting to think about the monetary circuit. It was not yet clear exactly what he had in mind, but I read many of his papers afterwards, after my PhD. And so, yeah, it was certainly an influence. Besides, Caldor, Eichner, and Basil Moore, one could add Basil Moore, yeah. Joan Robinson.
Yeah, it's funny because I've always, so this is my interpretation. There's been a lot of work or a lot of energy between the circuitists and the post-Keynesians, and in a large way, you are responsible for bringing, so to speak, Alain to America, and then the development of or these relationships between the monetary circuit and post-Keynesian economics. Anyways, my interpretation. In section 3, entitled In Defense of Horizontalism, there are 2 papers, I've told you this before, that for me stand out a lot. Your paper in Money in Motion, which for me remains a go-to article. If you want to, I really think it's a phenomenal paper because it summarizes a lot the post-Keynesian view without getting into the debate on horizontalism and structuralism, which you also deal with in another 1996 paper in the Scottish Journal of Economics. Specifically, the Money in Motion paper discusses the relationship between interest rates and income distribution, which is a very hot topic today in central banks, difficult to keep up to date with all the literature in the mainstream on that relationship, but they do it in a very different way. But I have in mind more the impact of interest rates on labor markets, on unemployment and wage, but they have that. But for you, it's really the relationship between the interest rate as an income to bondholders. You've developed this into what you've called the Pasinetti Index. So my question is, the last decade have seen very low interest rates, near zero interest rates. How relevant is this channel today? Is this something that post-Keynesians should still defend? Because a lot of the people are saying that that led to asset inflation, and low inflation is not the solution. What are your thoughts on that?
Well, I think that's the difficulty between looking at what happens when interest rates are already low and when interest rates are falling, moving towards zero. So when this happens, then there are large capital gains to be made both in the stock market and on the bond market. So it is, I mean, when we were thinking about this in the 1980s with Mario Saccareccia, yeah, we were only looking at the impact of the interest rate income that we were getting. And so we were not thinking in terms of capital gains and the fact that this would raise the value of wealth, whether you're holding bonds or whether you're holding stock market shares. So the comprehension of all this is much more difficult now, much more complicated, because as you say, we have observed that over the, well, with the COVID crisis, and also before that, 10 years ago, we observed, yeah, with very low rates of interest. On top of that, it encourages people to speculate and go on the stock market and buy more shares. So there's a higher demand for shares, therefore the value of shares is higher. So it's not so easy anymore to say that, low rates of interest are good because it will stop the rentiers from becoming rich. Now, it stops it from the point of view of the income you get, but not from the wealth point of view.
Well, my own view on that is that I don't see low interest rates as contributing to asset price inflation as much as the lack of regulations. For me, this is, because I think that there are more advantages to having low interest rates for the reasons that you know, and that what we need is some sort of macroprudential framework, or maybe a financial transaction tax of some sort, but some sort of ways of controlling the stock market per se, rather than playing with interest rates.
Yeah, there was a time where within post-Keynesian economics, or maybe the circuit theory, we were really concerned with credit as being mainly for productive purposes. But I read again this 1984 paper that starts the book, and I did notice that I do mention the fact that credit could also be for speculative purposes. That something has to be done to avoid that. Mm. So yeah, you're quite right. And the same with Wynne Godley. I also noticed that in his work in the 1980s, he's also concerned. I mean, it's not a long paragraph, but he has a short spot where he also discusses the issue of whether credit will be for productive or speculative purposes.
You know, I got the idea because 20 years ago, when I was still in Michigan, Alain Parguez and I started writing a paper, never got around to finishing it, but I have a bunch of notes from Alain on this topic that we had called the dual circuit. I still have the notes. It would be interesting to refresh them. Thank you. In section 4, you deal with 3 innovating articles. In what sense are these innovative relative to what you had done before?
Okay, well, there was one published in the Journal of Post-Keynesian Economics, where I think the innovation was that I tried to understand why it was that there were some people arguing that the Fed in the United States had not really control of short-term interest rates. And that was because the federal funds rate could move quite a bit from day to day. And so people thought, even some post-Keynesians thought that, well, that's because the market has an impact on the federal funds rate. And in that article, I showed the difference between what was happening in Canada and what was happening in the United States. And the difference was that in Canada, the central bank was able to know exactly what the supply of reserves was, and they also knew exactly what the demand for reserves was. Whereas in the States, this was not the case. That explained why in Canada, the equivalent of the federal funds rate, if you want the overnight rate, would barely move from day to day and would always be at the level targeted by the central bank, whereas this was not the case in the United States. So I think that was an interesting contribution. The second one, which I called innovative, was because it was right after the 2008 crisis. And I thought about how can we put in a stock flow consistent matrix, in a stock matrix, how can we take into account securitization and the shadow banking system. So other people had tried to do so, for instance, Lance Taylor with a French young author, Tariq Mwakil. But anyway, that was my first try at it. And people now like Bota Karvezadzi have written many papers trying to do so, getting the shadow banking system into a stock matrix. And it's not always easy. And the third paper is related to this Bazinetti index that Mario Saccareccia and I designed. And what I did is that I computed how many weeks of labor time it took to pay the mortgage of an average house in Canada. So I thought that was also interesting. It was a kind of labor theory of housing purchases. So one could see that, yeah, this could change quite a bit, whether if you bought your house in 1980 when rates of interest were above 10% up to 20%, that could take you a lot more weeks to pay than if you bought it at some other time. And I redid this recently for the United States and Canada.
Interesting.
Yeah.
Thank you. Section 5, you address monetary policy during the financial crisis. From a mainstream perspective, how different was monetary policy, and also from a post-Keynesian perspective?
Well, from the mainstream perspective, it was a kind of return to monetarism in the sense that they were trying to get the rate of inflation back up by doing open market operations, increasing the amount of reserves in the system. From the post-Keynesian perspective, I think the big change was that a few countries moved from a corridor system to a floor system. So the corridor system is a system where the targeted rate of interest is in the middle between the rate of interest on deposits at the central bank and the rate of interest on the funds that you borrow from the central bank. But in the floor system, which is the system that we got in a few countries since 2008, in that case, what happens is that the target rate of interest is at the floor. It's equal to the rate of interest on deposits of banks at the central bank. And so it meant that the supply of reserves, so to speak, could be different from the demand for reserves. Whereas us, among post-Keynesians, we had always claimed that the stock of reserves is demand determined and dependent on credit and the demand for reserves. So this forced us to change somewhat our overall view of how things work out.
But interest rates are still set by central banks, and it's just that the supply may be different than demand, but with no repercussions on the price.
Yeah, exactly. That some people at the Bank for International Settlements talked about the divorce between the rate of interest and the supply of reserves. That's exactly what it is. The rate of interest stays at the target despite the fact that you greatly diminish or increase the reserves.
Yeah.
So, but that's an interesting thing. And in fact, I just read a few weeks ago that at the Fed now, this is the system they will keep on doing, which is the floor system. They don't want to go back to the corridor system.
Thank you. I guess one last question on the book or on the book is given those 20 chapters, and in preparing the book, we both went through all the various articles, and one question is, how do you see your own evolution from that 1984 paper in the JEI to your most recent papers, one of which was published in the Review of Political Economy last year?
Well, I think that first, it's good to note, I think there's an improvement into arguing about what post-Keynesian endogenous money theory means. I think also that there's been an improvement in distinguishing clearly between the money stock and credit, on the other hand. I think that, and that we can say thanks to modern monetary theory, there's an improvement in understanding the relationship between the government and the central bank and the impact of, what the links between the government and the non-financial sector. Whereas before we were focusing always on the relationship between the central bank and the commercial banks, or the commercial banks and the firms. So I think now we have a more complete picture. And finally, I think we can say also we have a better picture of the relationship between the banks and the non-bank financial institutions.
Yeah, yeah.
Or the shadow banking system. I mean, this was forced upon us by what has happened in the real economy. But yeah, I mean, I think we always had the feeling that banks were special. They were different from non-banks. But now, over the last few years, we had to be more precise about whether this was true or not.
Yeah, I feel the same way. I feel that all these other elements were always implicit, never denied, but very much implicit. But now they've become more explicit, more part of the story, or part of that core story, where
I think also what happened is that some people claim that, yeah, the shadow banking system keeps creating monetary assets and credit, and so it forced us to think, okay, to some extent it's true. I mean, it is possible for mutual funds to make credit to some agent. But then it forced us to think, well, but what does it need? It needs funds, in fact, coming from somewhere else. And the somewhere else are the banks, the real banks. So yeah, we had to be more precise. ironically, we were helped a little bit, I think, by some mainstream people who suddenly realized that banks are special.
Oh.
And so they started criticizing their own mainstream colleagues in very clear terms. And so that also helped me to understand, make a clear difference between banks and non-banks.
Well, with respect to that, I think the BIS has done some interesting work. And I know that there are many papers that I've read that has sort of, germinated in my head in a number of ways without being heterodox in nature. They certainly raised some very interesting questions. Okay, Marc, I have a few more questions about just going beyond the book. One question is that you publish a lot of monetary policy, but you haven't dealt much with developing countries. Why is that? Is it that they have their own special challenges? Currency boards, dollarizations, original sin? And this is a question I also get when I go to Latin America as well.
Mm-hmm. Well, I haven't written about dollarization, but I did write about currency boards. So I did take that into consideration, and I think I have it right. But in general, whether it's monetary policy or whether talking about growth or things of that sort, I tend to be reluctant to talk about, to give advice to my economist colleagues who are, say, in Mexico or in South America, because or even in Poland or Hungary, because I think I have the feeling that my duty is to bring these heterodox theories to them, but then they are the ones who know very well what are the constraints on their economies. And so I believe they are the ones who know whether it applies or not to their economies. I think one of the contributions of these South American economists or Brazilian economists is the fact that they talk a lot about the hierarchy of currencies. And I think that's something important. And who brought this idea around? Well, it's those coming from the countries where they have to face these additional difficulties that we don't have in Canada, for instance.
Yeah. Well, 2020 was certainly the year of the COVID, and we've faced some very interesting challenges in addition to large-scale quantitative easing. What lessons can we draw from central bank activities in the time of COVID?
Well, as we discussed in the past, one could wonder how independent the central banks are now relative to the government. But I would say that we knew that already in 2008 with the subprime financial crisis that had also some impact in Canada. Just to take the example of Canada, at the time, the federal government still had a deficit that was equal to zero. But despite that, the government issued $50 billion worth of bonds and treasury bills. But the government had no deficit. So the reason they did that was to help out the banks, in fact, so that the banks would get access to safe assets and get rid of their mortgage-based securities or mortgages and so on. So, and
the central bank had run out of bonds, had it not?
Exactly. The central bank, well, it had not run out of treasury bills, but it was on its way to running out of them. And I think it was the same in the US. And today, well, we had again something similar where the federal government once again, issued many more assets than it needed to cover the deficit. And the central bank bought, lots of them. So not necessarily as being part of quantitative easing, but simply to keep interest rates low.
Yeah. Two more questions. We have a lot of people are writing on Bitcoins and also on the relationship between central banks and the environment, green QE, for example. How relevant do you think these are from a post-Keynesian perspective?
Well, talking about the environment, I know there's a lot of papers coming out saying that the central bank should, well, as you mentioned, should have green QE and all that. I'm a bit reluctant about this. I'm not sure it's the role of the central bank, or then you would be changing the role of the central bank quite a bit. I see the role of the central bank, of course, lender of last resort, making sure that the payment system works properly, financial stability. But environment to me seems to be an issue for the government, not really for the central bank. So maybe the government can set up a special bank, some green development bank, to take care of that. But I really feel I don't see the central bank as doing this. On top of it, many people suggest, the central bank could create money at zero interest rate for the government. But if it does this, then it means that but there's always a counterpart to this creation of money, and the central bank has to pay interest on that. And so this means that in the end, it wouldn't change a thing. I mean, the government would still have to pay interest on this so-called free money. So I'm not so much in favor of that. The other issue is what about all these electronic monies, Bitcoin and all that? And well, some of my French colleagues say that Bitcoin is not really money. It's more like a speculative asset. But we see that there are some efforts in using Bitcoins for transactions. My own view is that it should be banished. They should be made illegal. That's my view about it. I have the feeling that it's only protecting black market, fraud, and all that.
Are you familiar with Nouriel Roubini's term for Bitcoins?
No.
He calls them shitcoins.
Okay.
And he's been very aggressive on wanting to ban them, and for those reasons. Yeah.
I think it has been banned in a few countries, but most countries seem to be overly lenient about them.
There's also talk that it's the technology behind Bitcoins which is more interesting than the Bitcoin itself. I'm not a specialist, but I know.
Well, I know that in Canada they have studied this at the central bank, and they believe that the current payment system is still more efficient than the Bitcoin system. Than the technology that is backing the Bitcoin.
Yeah, good. One last question, Marc. One that I've been wanting to ask you for many years. If you could somehow give your younger self a piece of advice, what would you say to a young Marc Lavoie back in 1979?
Well, maybe I will have an answer that will surprise you. I would think they have to. There's one thing I regret is that I didn't really study econometrics, and the partial cause of this was that when I was at Carleton University, I did my 4 years of economics, but at the same time, I did 3 years of mathematics. So I took courses in statistics, but they were entirely based on the theory of statistics and not at all on the practical aspects of econometrics. And when I went to France, this was not one of the topics that we could choose, and so I never did it. So I think econometrics is a tool, it's a rhetoric tool, just like Deirdre McCloskey talks about, you know, the rhetoric of economics. So I mean, I'm like most post-Keynesians in the sense that I'm very reluctant to accept any proof based on econometrics, but it's part of the game. And I think we have to know about it, either to criticize mainstream work on it, or to use it as a rhetorical tool.
You know, Robin Rowley, that you also know, one of my professors at McGill, he had once told me something about econometrics. And that's how I learned econometrics, by the way, with Anna Koutsayanis and Robin, was always, and both of them had a very similar, they always said to me, you first have to get the story right. And I remember in Robin's class, we spent weeks and weeks and weeks trying to get the story right, and only the last couple of weeks of the class doing econometric exercises.
Yeah.
And then I recently found the introduction to the first issue of Econometrica, the first journal of econometrics, in which the editor says, econometrics is a tool to keep economists honest. And this is sort of exactly kind of what you're saying, and you know, but you, in another way, you sort of made up for it with having brought in stock flow modeling. Not exactly econometrics, but certainly a way of modelizing economics in a way.
Yeah, we didn't talk much about stock flow consistent models, but
no, we haven't. But on that topic, I just, you know, first of all, I had a conversation recently with someone about the future of ROPA. And they were asking me, are you going to accept more papers that use stock flow modeling? And I said, I have to. Otherwise, I'd have no papers. And it's sort of become, I think you say that in your paper there on institutionalists, where you say it's become sort of, you can't get a PhD today almost without doing some sort of, well,
I wouldn't say that.
most young people today, they do some sort of stock flow modeling.
Yeah, it's true that to argue that you will be doing serious work, many students, doctoral students say, well, I'll have at least one chapter with a stock flow consistent model in my thesis. Yeah, I think it forces, I mean, Wynne Godley thought that it would solve all the controversies. I think this was too much of a hope. I still hope that it puts some constraints on what people can say. But recent experiences have shown to me that, yeah, maybe the older post-Keynesians still don't understand exactly what those stock flow consistent models mean, or how they can improve what we say about the real world.
Yeah. For me, I've always saw it as very inevitable, logical, that you were the one who would usher in sort of this stock flow modeling, because I always saw a really clear link between that and the ideas within the monetary circuit, the idea that, you know, things move around and they travel, you know, and so I'm not surprised at all that you're the one who sort of brought, is this how you saw stock flow modeling as well?
Well, I realized or remembered a few weeks ago that back in 1984, I think, I had a stock flow consistent matrix in one of my papers back in 1984. But that was before Minsky, because he had one, but only around 1994. Yeah, that was before godly 1996.
Yeah, I'm not surprised. Let me get something off my chest. Having been your student for 35 years is both a blessing, but also some sort of curse, and I'll tell you why. In my career, I've had a couple of, I thought, very original ideas. But then I go back into some articles of yours from 20, 25 years ago, and guess what? There's a sentence or two precisely on that idea, exactly kind of what you're saying. And I've always thought it was just infuriating. And I'm guessing maybe I read those papers 20 years ago and somehow they stayed somewhere in my head. But that's happened to me twice. And I had this discussion with Virginie Monvoisin on this exact topic because it's happened to her as well. And in a way, this is a good way of closing this interview, because to go full circle, one of the reasons that I really wanted you to come out with this book was precisely because we often find good ideas in some of these old papers, whether it's your papers or older papers, what you call in your introduction gems, old gems. And I'm sure that this collection of essays will be very much appreciated by everyone, and especially by young scholars.
Yeah, well, yeah. The book is pretty expensive, so I do hope that the libraries will buy it.
It does
so
come in an e-copy as well.
That's right. So that's cheaper.
Yeah, it is cheaper. So, well, Marc, thank you very much. It was a pleasure. And I didn't think it would take 50 minutes, but there you go.
Well, thanks, Louis-Philippe, for doing this interview and finding all those questions.
Thank you, Marc. À la prochaine.
OK, salut.
Bye.